40% win rate sounds reasonable until you're staring at your seventh consecutive loss. A 7-loss streak is mathematically guaranteed within your first 120 trades with even a standard 40% win rate. That's exactly what happened to me in the current month of January trading NQ with the current change in market conditions. Let me be specific about the math here, because this number should terrify you. With a 40% win rate strategy over 120 trades, there's a 97% probability that you'll experience at least one streak of 7 consecutive losses. 97%. That's not if you're unlucky. That's not worst-case scenario. That's virtually guaranteed. A mathematical certainty baked into the structure of your strategy. December was a great month for me. I had a 45% win rate with an average risk-reward of 1.6R. The market was choppy with clean sweeps at key levels. My strategy thrived in those conditions. Fade the sweep, catch the reversal, take profit at the next level. The math worked beautifully. I was profitable, confident, trusting the process. Then January hit. Market regime changed completely. Instead of respecting sweeps and reversing, NQ started blowing through them and making massive directional swings. The choppy, range-bound behavior from December disappeared overnight, and I hit trade number 120 in my sample. Mathematics delivered exactly what it promised. 7 straight losses. The strategy didn't break. The math still worked over the full sample. But something else broke. Me. And this is what nobody tells you when they're pushing high risk-reward ratios and low win rates. They show you the math that proves profitability. They don't show you the math that proves psychological destruction. So let me show you what everyone's hiding. With a 40% win rate, you're losing 60% of your trades. That's 6 losses for every 4 wins. Already, that's an uphill battle psychologically. You're spending more time being wrong than being right. But it gets worse. Way worse. The probability of hitting a 7-loss streak within 120 trades at 40% win rate is 97%. It's not a question of if. It's a matter of when. And when it does show up, it doesn't matter that you're still profitable over the full sample. It doesn't matter that your risk-reward ratio is solid. Because in that moment, staring at 7 consecutive red trades, your psychology is shattered. This is exactly what happened to me in January. And this is what made me remind myself of the importance of not always aiming for a high risk to reward. Want to know why everyone keeps pushing low win rate strategies anyway? The entire trading education space is obsessed with high risk-reward ratios. Scroll through trading Twitter, trading YouTube, trading Instagram. It's all the same narrative. Only take 1 to 3 setups. You only need a 30% win rate to be profitable with proper risk management. Let your winners run, cut your losers short, and they'll show you the screenshot. One beautiful winner. $100 risked, $300 gained. Sometimes $500 gained. It looks professional. It looks disciplined. It looks like mastery. But here's what you never see. The screenshot of the 7 losses that came before that winner. The screenshot of the account balance bleeding down while they waited for that one setup to finally work. Let's talk about why this narrative is so dominant. Because understanding the game being played here will save you years of pain. First reason, screenshots sell. A 1 to 5 risk-reward winner is content gold. You risked $100. You made $500. That's a story. That's inspiring. That's the kind of post that gets engagement. Someone posting, "I went 6 for 10 today at 1 to 1 risk reward," sounds boring. Sounds average. Sounds like they're grinding instead of crushing it. The entire content economy of trading rewards the big winner screenshots. It ignores the loss frequency. High risk-reward ratios photograph well. They tell a compelling narrative of precision and expertise. High win rates? They're harder to make exciting. I won 60% of my trades this month doesn't generate the same dopamine hit as "I caught an 8 or winner on NQ. The asymmetry here is massive. One big winner makes for a great story. 10 smaller wins that add up to the same profit? That's just work. That's boring. That doesn't inspire people to sign up for the course or buy the indicator. And the content algorithms love this too. Big dramatic wins get shares. They get saves. They get comments. The algorithm rewards this type of content, which means more traders see it, which means more traders think this is how you're supposed to trade. It's a self-reinforcing cycle that has nothing to do with what actually works psychologically for most traders. Second reason, it sounds sophisticated. When someone tells you they only need a 33% win rate because their risk reward is 1 to 2, they sound like they've figured something out. Something you haven't. They sound disciplined, strategic, like they've transcended the emotional need to be right most of the time, because they've mastered position, sizing, and risk management. There's a status signal embedded in low win rate strategies. It implies you're so good at trading that you can afford to be wrong most of the time and still win. It separates you from the emotional traders who need constant validation from winning. It makes you sound like a professional. The language around it reinforces this too. Sniper trading, quality over quantity, surgical precision. All of it suggests that taking fewer trades with lower win rates, but higher rewards is somehow more advanced, more evolved. The reality? Most people can't psychologically handle being wrong 60 to 70% of the time. But admitting that feels like admitting weakness in a space that worships toughness and discipline. So traders pretend they can handle it. They force themselves into strategies that sound sophisticated but slowly destroy their confidence. And they suffer in silence. Because admitting the psychological struggle would mean admitting they're not cut out for professional trading. Here's the third reason, and it's a big one. It feeds the lottery brain. Be honest about what a 1 to 5 risk-reward setup really represents. It's a lottery ticket with better odds than Powerball. It's the promise that you can be wrong most of the time and still hit it big when you're right. You can lose, and then boom, one big winner wipes it all out and puts you in profit. That's appealing. That's hope. That's the dream. Humans are psychologically wired to love this. We overweight small probabilities of large payoffs. It's why people buy lottery tickets despite terrible expected value. It's why we love underdog stories. It's why we chase 10 baggers in the stock market. High risk-reward trading taps into this exact psychological vulnerability. Except now, it's wrapped in the respectable language of professional trading and risk management. It doesn't feel like gambling when you call it a 1 to 5 risk-reward setup with proper position sizing. But the psychological mechanism is identical. Sacrifice high probability for high payoff and hope you can emotionally survive the drought between winners. And here's the thing. Some people can survive those droughts. Some traders genuinely have the psychological makeup to be wrong 7, 8, 9 times in a row and still take the next trade with full conviction. But that's rare. Much rarer than the trading education space wants you to believe. For every one trader who can genuinely handle low win rates, there are 10 who think they can. They discover during their first real losing streak that they absolutely cannot. Fourth reason, and this is the big one. It's incredibly easy for core sellers to sell. Think about the pitch. You only need to win 30% of the time to become rich with this strategy. That's a low bar. That sounds achievable. If someone's struggling to be profitable and you tell them they need to win 60% of the time, that sounds daunting. That sounds hard. But 30%? That's just 1 out of 3 trades. Anyone can do that, right? It's the perfect sales narrative. It makes profitability sound accessible while simultaneously excusing the losses that new traders are already experiencing. Oh, you're losing a lot? That's totally normal. You're supposed to lose 70% of the time. Just make sure your winners are bigger. It shifts responsibility away from the strategy or the education. It puts it on execution. It gives the struggling trader hope that they're closer to profitability than they think. They just need to let their winners run more. Meanwhile, the core seller gets to post their handful of massive winners, completely obscure their loss frequency, and maintain the illusion that this path leads to consistent profitability. The struggling trader never sees the 97% probability of a 7-loss streak. They never see what that does to someone's psychology in real time. They just see the winners and think, I need to be more disciplined. And when they inevitably struggle with the psychological weight of constant losses, they blame themselves. They think they're not disciplined enough, not mentally tough enough, not professional enough. They never question whether the strategy itself is psychologically unsustainable for most people. They just assume they're the problem. That's brilliant marketing, honestly. Sell a strategy that's mathematically sound, but psychologically brutal. And when people fail, they blame themselves instead of the strategy. Then they buy the next course hoping that one will be the answer. Now let me tell you what actually happens when you trade a 40% win rate strategy in real market conditions. December, I'm crushing it. 45% win rate with 1.6 our average. The market's choppy, but it's predictable choppy. NQ sweeps the lows, I fade it. It reverses, I take profit. Clean, mechanical, profitable. The strategy works perfectly in that environment. I'm losing more than I'm winning, but the winners are big enough that the math works out beautifully. I'm building confidence. I'm trusting the process. Every loss feels acceptable because I know the next winner will more than make up for it. And in December, that's exactly what happens. The wins come often enough and big enough that the losses feel like just part of the game. Then January arrives and everything changes. NQ stops respecting the sweeps. Instead of sweeping and reversing, it blows through key levels and makes massive directional swings. The choppy character from December is gone. My fade to sweep strategy that worked perfectly last month, now it's catching falling knives. And then it happens. Loss 1, loss 2, loss 3. By loss 4, doubt creeps in. Is the strategy broken? Did January kill my edge? Should I stop fading sweeps in this new environment? Loss 5 hits, and confidence starts cracking. I've given back 2 weeks of December gains. Every entry now comes with hesitation. Every stop out feels like confirmation that something's fundamentally wrong. Loss 6. My hands are shaking on every entry now. Every instinct is screaming that this isn't working. The rational part of my brain knows this could just be variance. But the emotional part doesn't care about statistics when the account is bleeding. Guess what happened on trade 7? 7. Straight. Losses. Something breaks. It's not about the money anymore. It's about being wrong 7 times in a row. It's about questioning everything. Your strategy, your ability to read markets, your decision to trade at all. You start thinking about all the time you've invested, all the hours studying charts, all the backtesting, all the screen time, and you can't even get one trade right out of 7. The doubt becomes all-consuming. Maybe you never had an edge. Maybe December was just luck. Maybe you're fooling yourself thinking you can do this. And here's what happens next. This is the part that actually matters. You start strategy hopping. 7 losses feels like undeniable proof something's wrong. So you abandon the strategy, maybe right before it's about to work again. You go searching for something different, something that wins more often, something that feels safer. You convince yourself that the problem is the strategy, not the market conditions. So you switch to something else. And now you're starting from scratch with a new approach right when the old one might have been about to start working again. Or you start revenge trading. You're so desperate for a win that you start forcing marginal setups, violating your rules, chasing that dopamine hit of being right. You see a setup that's close to your criteria, but not quite there. Normally you'd pass. But after 7 losses, you talk yourself into it. You need this one to work. You need to prove to yourself that you can still read a chart. And when that one fails too, it gets worse. Now you're 8 losses. Now you're completely untethered from your strategy. Or you tilt completely. You increase position size because you're due for a winner. The gambler's fallacy kicks in hard. 7 losses in a row. The next one has to work, right? So you double your size. Maybe triple it. And if that one fails, you've just turned a manageable drawdown into a catastrophic one. This is the psychological destruction that comes with low win rate trading. This isn't theoretical. This is what I lived through in January. The strategy was still profitable over 120 trades. The math still worked. The edge was still there in the data. But I was a complete mess. And a complete mess can't execute a strategy properly, which means the edge becomes irrelevant. And this is why I'm now convinced that for most traders, higher win rate matters dramatically more than high risk-reward ratio. Let me break down exactly why. First, confidence compounds in both directions. When you're winning 55 to 65% of your trades, each win builds momentum. Each win reinforces that you're reading the market correctly. Each win deposits a little bit of certainty into your psychological account. That confidence makes you calmer on the next trade, makes you more patient waiting for quality setups, makes you more disciplined in execution because you trust that when you follow your rules, good things usually happen. You're not hoping the next trade works. You're expecting to work more often than not. That's a completely different mental state. Compare that to a 40% win rate where you're losing more often than winning. Every trade becomes tinged with doubt because statistically, this one probably won't work. You're entering every trade with a baseline expectation of failure. You're hoping it works, but expecting it won't. That doubt makes you hesitant, makes you second-guess your entries, makes you exit early because you don't trust the setup to follow through. And when losses do come, which they do 60% of the time, each one chips away at your confidence a little more. Each one confirms your suspicion that you don't really know what you're doing. Low win rates erode confidence through sheer frequency of being wrong. High win rates build it through frequency of being right. And in trading, confidence isn't a luxury. It's the foundation of consistent execution. Without it, you can't take the trade you're supposed to take. You can't hold the winners you're supposed to hold. You can't follow your rules when it matters most. Second, you can actually trade the strategy. This seems obvious, but think about it carefully. A strategy you can't psychologically execute isn't really a strategy. It's just a theoretical edge on a spreadsheet. With 55 to 65% win rate, most traders can stick to the plan. They can take the next trade after a loss without shaking hands. They can follow their rules because the losses don't feel like existential threats to their identity as a trader. A loss with a high win rate strategy feels like variance, like noise, like part of the game. You're winning more often than not, so individual losses don't carry the same psychological weight. With 30 to 40% win rate, even disciplined traders struggle after a few losses. Because losses aren't the exception, they're the norm. You're losing most of the time, and after a while, that wears on you. And when you can't execute the strategy as designed, backtested results become completely irrelevant. You could have the best strategy in the world, perfect edge, beautiful risk-reward. But if you're emotionally abandoning it after every losing streak, you'll never realize that edge. What's the point of a mathematically profitable strategy if you emotionally abandon it during inevitable losing streaks? The best strategy in the world is worthless if you can't execute it consistently. Third, the math isn't even that different. Everyone assumes chasing higher win rates sacrifices profitability, that you're leaving money on the table, that you're being too conservative. That's not true. Let me show you. Strategy A, 40% win rate, 1 to 2 risk reward, over 10 trades, net $200. Strategy B, 60% win rate, 1 to 1 risk reward, over 10 trades, net $200. Identical profitability, same risk per trade, same net result, same expectancy, but the psychological experience is completely different. Strategy A, you're losing more than winning, constantly fighting the emotional weight of frequent losses, experiencing longer losing streaks, dealing with 97% probability of 7 consecutive losses over 120 trades, always feeling behind, always fighting uphill. Strategy B, you're winning more than losing, building confidence with each trade, shorter losing streaks that are less frequent, psychologically sustainable. You feel like you're winning the game, not desperately trying to survive it. And here's the kicker. Strategy B is often easier to achieve than strategy A. Why? Because you're not trying to squeeze outsized gains from every winner. You're not trying to hold through multiple profit-taking levels, hoping for the home run move. You're not fighting human nature's desire to take profit. You're just trying to be right more often, which is frequently more controllable. You can improve your win rate through better trade selection, through better entry timing, through better market condition filters, through better understanding of when your edge is present and when it's not. You can't always control whether the market gives you a 2 or move or a 5 or move after your entry. But you can often control whether your setup has a 40% or 60% probability of working in the first place. Control what you can control, and win rate is often more controllable than risk-reward. Fourth, losing streaks are dramatically shorter and less frequent with higher win rates. That 97% probability of a 7-loss streak at 40% win rate, at 60% win rate, it drops to about 2.8% over 120 trades. That's the difference between this will almost certainly happen to you and this probably won't happen to you. Think about that. With a 40% win rate, you're virtually guaranteed to experience a psychologically devastating 7-loss streak. With a 60% win rate, you'll probably never see it. Even when losing streaks do occur with higher win rates, they're typically much shorter. 3 or 4 losses instead of 7. That's still uncomfortable, but it's manageable. It doesn't shatter confidence the same way. You can emotionally recover from 3 consecutive losses. You take a break, review your trades, make sure you're following your rules, and get back to it. 7 consecutive losses? That changes something in you. That creates trauma. That makes you question everything. That kind of losing streak can haunt you for months, making you hesitant and fearful even after the streak ends. The psychological damage from a 7-loss streak can persist long after the statistics say you should be over it. Fifth, feedback comes faster and clearer. With higher win rate, you know quickly whether you're on track. If you're supposed to win 60% and over 20 trades, you're only winning 45%, that's a clear signal something's off. You can investigate. Are you taking trades outside your rules? Are market conditions not suitable for your strategy? Are you executing poorly? The feedback is clear enough to diagnose and fix the problem. With 40% win rate, feedback is muddier. You could be at 30% over 20 trades and still be within normal variance. You could be executing perfectly and just hitting a rough patch. Or you could be completely off track and not know it yet. Are you underperforming? Or is this just a rough patch? Are you supposed to be in a losing streak right now? Or has your edge disappeared? The uncertainty itself is stressful, and it makes it much harder to course correct when something genuinely needs adjusting. With high win rates, you get clear signals quickly. With low win rates, you're flying blind for much longer sample sizes. Let me address the obvious objection. But what if I can't find a 60% win rate strategy? Here's the reality. Most traders aren't struggling to find high win rate strategies. They're struggling because they've been conditioned to believe high win rates don't matter. Or worse, that pursuing high win rates is somehow less professional than chasing high risk-reward ratios. You can find high win rate strategies everywhere. Mean reversion in range-bound markets. Range trading between clear support and resistance. Trend continuation after pullbacks to key moving averages. Breakout retests at previous resistance turn support. These aren't exotic. These aren't complicated. They're often simpler and more straightforward than the low probability, high reward setups that look good in course marketing. The issue isn't availability. The issue is traders have been sold on the idea that chasing 1 to 3 or 1 to 5 risk reward is the proper way to trade. And anything else means you're leaving money on the table. But what good is theoretical money on the table if the alternative is leaving your confidence, discipline, and psychological stability in ruins? What good is a bigger average winner if you can't psychologically take the next trade after a losing streak? Let's talk about what you should actually aim for. Aim for at least 50% win rate, ideally 55 to 65%, with risk-reward of at least 1 to 1. That's it. That's the baseline for psychological sustainability. Win 55% at 1 to 1 risk-reward, you're profitable. Push to 60%, comfortably profitable. Occasionally catch runners that push average to 1 to 1.5, you're doing very well. This isn't sexy, won't get you featured on trading Instagram, won't generate viral tweets, won't make you sound sophisticated at trader meetups, but it keeps you in the game psychologically. And that's what actually matters. Because staying in the game long enough for your edge to play out is the whole game. Everything else is just details. Because here's the uncomfortable truth nobody wants to say out loud. Most traders don't blow up because their strategy is mathematically unprofitable. They blow up because they can't psychologically handle the drawdowns and losing streaks that come with their strategy. They strategy hop at exactly the wrong time, right before the edge would have worked again. They revenge trade after painful losses. They increase size when desperate for a win. They quit in disgust, right before things would have turned around. All of this is psychological. None of this is mathematical. And all of it is dramatically worse with low win rate strategies where 7-loss streaks are virtually guaranteed. The real edge in trading isn't finding the perfect 1-5 setup. It's not catching the home run trades that look amazing in screenshots. The real edge is being psychologically stable enough to execute your strategy consistently over hundreds of trades without blowing up emotionally. And for most people, not all, but most, that psychological stability requires winning more often than you lose. It requires feeling like you're good at this. It requires feeling like you know what you're doing. It requires feeling like trading is a skill you possess, not a lottery you're playing. The January regime change taught me this lesson the expensive way. 7 consecutive losses with a profitable strategy showed me that mathematical edges mean nothing if you can't maintain the emotional composure to execute them through rough patches. So I adjusted, started focusing on higher probability setups, even if it meant smaller average winners. Prioritized win rate over risk-reward ratio. Stopped chasing home runs, started taking base hits. Stopped trying to sound sophisticated with low win rate strategies. Stopped trying to impress people with big risk-reward screenshots. Started focusing on what actually works psychologically for me. And you know what happened? My trading got boring. My results got consistent. My confidence stabilized. The emotional roller coaster flattened out. I stopped dreading my trading sessions. Stopped feeling sick to my stomach before taking a trade. Stopped questioning everything after every loss. Boring and consistent beats exciting and volatile every single time in this game. If you're struggling with confidence right now, if you're strategy hopping, if you're tilting after losses, if you're revenge trading, check your win rate. Because I'd bet money you're trying to make a low win rate strategy work. And it's slowly breaking you psychologically, one loss at a time. You don't need 70% win rate. Don't need perfect accuracy. Nobody does. But you need to win often enough that losses feel like temporary setbacks instead of confirmation that you have no idea what you're doing. For most traders, that number is somewhere around 55 to 60%. High enough to build and maintain confidence. Low enough to be achievable with solid strategy and execution. And it pairs perfectly with 1-to-1 or better risk-reward for consistent profitability. The trading education space won't tell you this. Doesn't sell courses as effectively. Doesn't generate viral content. Doesn't make you sound sophisticated when explaining your approach. But works. And it's psychologically sustainable. And in the long run, psychological sustainability is the only edge that actually matters. Everything else, the fancy indicators, the complex strategies, the sophisticated sounding approaches, all of it is worthless if you can't execute it consistently. Stop chasing 1-5 setups that look incredible in screenshots but destroy your confidence when they fail 8 times in a row. Stop buying into the narrative that you only need to win 30% of the time, as long as your risk-reward is good enough. Stop pretending you're psychologically tough enough to handle a 97% probability of experiencing 7 consecutive losses. You might be, but probably not, and there's no shame in that. Start building a strategy you can actually execute when a market turns against you. Start prioritizing psychological sustainability over mathematical optimization. Because the best strategy in the world is completely worthless if you abandon it during a losing streak. And the only way to avoid abandoning it is to build something you can emotionally tolerate when mathematics delivers its guaranteed losing streaks. My 7-loss streak in January was the tuition I paid for this lesson. You don't have to pay the same price. You can learn from my mistake right now. Win rate matters more than almost anyone in trading education will admit. And if you're not winning at least half your trades, you're making this game significantly harder than it needs to be. Aim for 50% minimum. Push for 55 to 60%. if you can. Pair it with 1-to-1 or better risk-reward. Execute consistently. Stay boring. Stay stable. Stay in the game long enough for the edge to play out. That's how you actually make it in trading. Not with the highlight reel winners that course sellers post to sell their products, but with the unglamorous, repeatable, psychologically sustainable consistency that comes from winning more often than you lose.